Thank you so much for joining us and being here today, sir. It's an absolute honor and privilege to be introducing you to the audience. I know, sir, you do not need an introduction. Uh, Everybody who is in the stock market probably among the most used terms, Nifty and Sensex, and you being the man who coined the word Sensex, probably the whole market, everybody knows you. So I don't think that I even should be saying that it's an introduction, but it's just a warm welcome that I wanted to give you here, sir. And I was just thinking, that while if I go and introduce Deepak sir, what is that I'm going to say about him? Then I figured out that Deepak sir did, passed out from IIT-IIM even when I was not even born at that time. So he brings in decades and decades of experience, has seen the market much more than any one of us, has been truly a man who has been like eating, sleeping, walking, talking markets all the time. So an IIT-IIM alumnus and the founder of Trendwatch India and one of India's best known stock market experts. So Deepak sir, truly an honor to have you here, sir. I can't even say that how glad I am, how privileged I am to be having you here today. I'm pretty sure our students are going to have an amazing session, amazing learning over the next 35, 40 odd minutes. So gentlemen, before I hand over the talk to Deepak sir, just two ground rules, gentlemen. We have deliberately kept all of you on mute for the reason being so that when sir speaks, it's very loud and clear. But that doesn't deter you from asking questions. You can write your questions in the chat and I'll take your questions from sir at the end of his talk. We will make sure that we will try to make it interactive at the end when sir opens up for the questions. So that's about it. And when Deepak sir ends, I'll come back again. Because he has limited time, precious time, I'll come back again. We'll talk to you about 5-10 minutes about the feedback and other stuff, and then we'll wind up. So that's the format of the day. With that, I hand it over to Deepak sir. And sir, once again, a very warm welcome and thank you so much for being here, sir.
Well, thank you very much for having me here for this session. Am I coming through loud and clear, hopefully?
Absolutely, sir. Absolutely clear.
Great. So I will proceed. Now, I'll be talking for about half an hour, after which I'll take on all the questions that you've got to ask. We'll try to answer them very quickly so that more questions can be accommodated. Now, the question was, what does one talk about in half an hour about the markets? So I gave a thought about it, and the answer is everything. Let's talk about everything we really need to know about the market. So this is a top-down approach. Most of the time when you are dealing with the markets, you're either dealing with news or you're dealing with some sort of a trading method or an investing method or reading people's theories. But what is the entire market? What do you do with it? Why are you there? So let's answer these questions. Let's begin with the first one. Why is the market there? And what do we do with it? The answer to that is markets, as you're already aware, have been created to allow everybody, I'm putting it a little differently from theory, to own a chunk of a company. You become an owner when you buy the stock. So you're participating in what the company does, and the company does well, your share price goes up, you also build wealth, and everybody's happy thereafter. The opposite we will not get into. So the question is, why should we invest in the market? That is the more important question, and that is why you're also learning about the market. The reason is simple. What do you do with the money you save? All of you will be having a job sooner or later if you don't already, or you're running a business. In the process, you make cash. Now, that cash has got to go somewhere. Most of the time, if you put it in fixed deposits, you will not earn enough interest to keep up with inflation, which means what? You got some amount of money today, say you got 1 lakh rupees, you can buy some things with 1 lakh rupees. 1 year later, because of inflation, those same things will cost more than 1 lakh rupees, plus the interest that you earn from the bank. So all the time, what will happen is your buying capacity will keep coming down. So you need to do a little bit better than putting your money simply into banks and earning a fixed deposit. And that's where investments in markets come in. But if you're investing in markets, you have a slight problem. They go up and down. They don't just keep going up nicely like your fixed deposits. So how do you solve this particular problem? Well, there is a second problem also along with it. You don't know when they will go up and down. So, that it would be very nice if you knew that 1 year from now markets will be down. So I say, okay, I'll put my money in fixed deposits, so no problem. You can't do that. So you have to deal with randomness and volatility. What is volatility? Volatility, we mean high volatility is actually computed by taking the standard deviation of the percentage changes in a price over time. That means that if there is a lot of fluctuation from day to day or month to month or week to week, you'll have high volatility. This volatility can be up as well as down. We don't worry about volatility going up, but we do worry about volatility going down, taking the markets down. So we have to deal with two things. One is you put your money in markets, and 1 year from now, you might actually have a 10-15% negative return. Question is, how do we solve this problem? The answer is long-term investing. That means you there are a lot of criterion for buying stocks, for building portfolios. There are many, many ways you can do this. So we are not obviously going to get into the details in this course, in this class, but we will look at what some of these methods are a little later. But the point is that if you make a certain decision to invest in the market, you have to commit to the market for a longish period of time. Typically, over 3 years, you will be doing much, much better than your fixed deposits, even if the first year or the first few months are bad. So, so this is it. You will be getting your returns in the market in the longer term. Also, if you have an income every month, then you have an even better strategy. What you simply do is you take a little bit of that income, a fixed amount, and you keep putting it in the market every month. The beauty of this method is very simple. Whenever the market is going down, you're buying your stocks cheap. And whenever they're going up, well, I mean, they could go up further or they could go down. But if they go down, you're again going to get them cheap. So the averaging out over, in fact, you may not even have to wait 3 years. You'll most likely start getting positive returns in the first year itself if you start putting in money every month into the market. So this is the most important thing that you do with the market. You will hear about hundreds of other things you can do, how you can trade, how you can day trade, how you can buy options, etc. But all of you will be earning and all of you will have to save the money somewhere. And that somewhere is the stock market. Maybe you put a little bit for your emergency cash needs in FDs. I mentioned FDs and not any other instrument because those are the safest. But what you're putting in the market is something you don't need every day. You just put it there, put it mindfully every month, and you will be getting your returns. And this is something all of you must do because 10, 15 years down the line, you'll be sitting on a very nice portfolio out there. That the ways you get in and all are, we'll come to one very important way actually a bit later. But this is the important thing, and this is why we invest in the market and why we are interested in the market. So to sum up this little bit that we have spoken about so far, market is there to, from your point of view, to give you an instrument where you can invest your savings and see them grow over a period of time. That period of time is the long term. So you don't really worry about everyday news. You don't worry about Ukraine. You don't worry about COVID. You don't worry about the RBI. So RBI is the least of everybody's worries right now. So effectively, you don't really worry about the markets. You just keep putting in the money. And it is really simple and arithmetical because when things are bad, since you're putting in money every month, you will also be buying stocks at the cheapest. Though at that time, they may not seem that it's the cheapest. So that in a nutshell is why you should invest. Now, so this is, and there is of course the power of compounding in the markets, which I should not forget. So what the markets will do is they will give you dividends in the stocks you own. The dividends may seem very small. I mean, you might have put in 1 lakh rupees, and you'll get, say, in the year 1,000 or 2,000 rupees. You say, oh, that's, why shouldn't I go out for a dinner with friends instead? A small amount, don't worry about it. But the compounding that comes in here, you put in that small amount, 1,000, 2,000 back into the market. And across a lot of stocks, you will find it makes a huge difference. For example, if you take the SENSEX is currently, goes between around about 50,000 here or there. But if all the dividends of the SENSEX had been put into the SENSEX would be closer to 100,000 today. So this is over a period of time, 30, 35 years. So, but at some point of time, you will also be 30, 35 years from now. And at that point of time, you will see a huge difference in your savings or what you've got in your portfolio. So this little bit of putting in those dividends back into the market will make a huge difference for you. So this is really, we have started with personal advice on what you should do with the markets and why you should take them seriously, and what is the primary purpose of the market, not just for you, but for instance, if you take a job with a investment company or something, this is what a lot of people want. They want to put their money into the markets. You hear on things like Twitter and social media and TV channels, all the talk is about trading. What can I buy for the next week, etc. Trading is for fun. There are not too many people who make money on trading. In fact, one of the top stockbroking houses in India, their head told me that 98% of their accounts end up in the red at the end of the year, any 1 year. So the odds of you making a lot of money on trading are not very high. Money can be made on trading, short-term trading, but don't count on it. And most of all, at some point of time, you'll be fed up with your boss and colleagues, the work you do, and you'll say, hey, I want to give this all up. I've got this investment portfolio, it's doing pretty well. Why don't I just spend all my time in trading and making money? I can make money better if I devote more time to it. Right now, because of my job, I can't really look at the market that much. And even without doing anything, I'm making so much money. So the markets can give me a lot more money if I get into it full time. This is wrong. This won't work, because you are abandoning a good method for a lousy method. When you have got a job, you're getting an income coming in, and that's the money that's going in the market. First thing you do when you give up a job is that money is stopped. So what money are you going to put in the market? You will start borrowing from friends and relatives. Soon you won't have those friends, and your relatives will run away whenever they see you. So don't borrow money to trade. Keep it simple. Just invest in the markets long term. Excuse me, this. Yeah, I think I'm back. So just invest in the market long term without worrying too much about making short term profits. If you are trading, trade purely for fun. If you're making money in the process, great, you can pursue it. But trading needs capital. Investing, you are just putting your savings there. You need constant capital coming in for trading, which is not easy to do if you don't have a job. Okay, so that's, again, we're still on the personal advice part of it, but there is the transition from personal advice into the methods of the market is a very natural one. So we'll get to that. First, let's understand the markets. What happens here in the markets? Why do people who invest in the long term generally make money? I mean, the best portfolios, as somebody had found out in some studies, may have been JP Morgan or someone, they analyzed all their accounts and found which accounts had made the highest returns. And they found they were the accounts of dead people. It's a little morbid, admittedly, but what had happened here is the dead people didn't do anything with their portfolios. They just remained there, and that helped the portfolios to grow. Because the trouble is, we have a barrage of, no matter how dedicated a long-term investor you are always going to get disturbed by the news. There is something that will, every day there is something in the news which will tell you how bad things are. And things are always bad. I mean, that's a permanent state of affairs. It's nothing to worry about. So eventually you'll always make some mistake somewhere. You have a good stock, you say, okay, it's not doing so well, let's get rid of it. And then it starts going up after that. You miss out on the move, which is why leaving a portfolio just alone and doing nothing with it is often the best possible strategy. If I look at my friends who graduated with me, some of the best portfolios are those people who did nothing but just apply for public issues whenever they came about. And they just kept the stocks there and forgot about it. And now they say that, oh, I've got quite a stake here. So, and all the guys who are very active in investing, they have done okay, but nothing like what the ones who just bought and forgot their stocks. Some companies, of course, disappear, but most don't. So why does this happen? I mean, why should stocks keep going up? We have seen from the past it has happened, but what if suddenly this all changes and from tomorrow the stock market just keeps going down for the next 20 years? Can that happen? Now, stock prices are random. I mean, you can't really predict what will happen. So there'll be a small probability even that could happen. It's extremely unlikely, but it's always possible. I mean, there's a possibility a nuclear bomb is dropped tomorrow as well. So we don't really worry about the improbables. The reason for the stock markets to go up all the time is simply because the companies grow. It's like the GDP. The GDP of a country keeps growing. In fact, it's exactly like the GDP, because there is always growth. There may be 1 year of negative growth, but ultimately GDP is higher any 1 year than 3 years earlier. Similarly, most companies, if they're profitable companies, are bigger companies than what they were 3 years back or 4 years back. They may not have grown as much as some company which grew much faster, but nevertheless, the companies are bigger. Now, if the companies are bigger, they have more assets, and the stock price is nothing but a reflection of what they own. So the stock prices are higher. This is a simple explanation about why stock prices keep going up. So you shouldn't worry too much about them going down in the long term. If you do something very speculative, then you could end up with something which just was a scam or was a company that was about to be wiped out, and you're stuck with it, and that's where you lose money. Okay, so they keep going up. Then why are we worried about why don't they go up in 1 year? Why shouldn't they go up every year? Now that is where the market's randomness comes in. There are two important hypotheses to be learned about in the market. If you do a financial course in markets, you'll find these two hypotheses are always mentioned. They're the most important ones. One is the random walk hypothesis, and one is the efficient market hypothesis. Now, why do we talk about this in a 30-minute talk? Because they're extremely important. And the second reason is people don't care about theory. People should care about theory because the markets have been around for a long time. The market is nothing but data. And what can analyze data better than computers? So believe me, everything that can happen in the market has been analyzed to the bone. Now the academics know a lot more than fund managers. You'll be told otherwise. You will find fund managers are always mock professors. That professor made money. They have made money. They've made lots of money. All my friends who are finance professors, they're millionaires in the US without exception. And they're all doing one thing in common. I'll come to that later. Then they have applied a very simple investment strategy over the years, and it's paid off. If I forget to tell you this by the end, please ask me the questions. Okay, so so trust academic wisdom. I mean, I'm not a PhD in finance or I haven't studied though I teach the stuff, I've not done a formal financial management. I mean, whatever was taught, the rest is all read. But now I go more and more to find out what the universities are finding out, because the truth lies there. And surprisingly, most investors and traders don't reach out there. And so they miss out on a lot of very good information on what you can do. Okay, so that's why we need these two theories, because everything in finance is based on these two theories. And these are, sorry, they're not theories, they're hypotheses. I should mention what is the difference between a hypothesis and the theory. Both the hypothesis and the theory are basically, they're not proofs. They're not like your right angle triangles proofs. These are reasonable explanations for what is seen happening. That's what both theories and hypotheses are. But the difference is in a theory, you can show it with data. So you can't really prove it that this is true, but you can say, look, the data shows that every time this happens, it is explained by this formula. Now, I cannot prove that this formula applies, but this is very reasonable, so we can proceed with it. So that is what we call a theory. A hypothesis is where you cannot prove it with the data, but it seems to be reasonably true. Most of the things we see will look like that. So that is why in the market, these two things are hypotheses and not theories. The random walk hypothesis simply tells the, I mean, there are a lot of things we can talk about in the random walk hypothesis, but let's talk about the most important thing, which is that stock price predictions are random. Stock price changes are random, which means I do not know what the price of anything will be on Monday at any time of the day. I don't know what it will be 1 week from now. I don't know what it will be 1 month, 1 year, 10 years, anything. Those prices are unknown. Nobody can predict them, not just me. Nobody can accurately predict. This goes against the wisdom of everything that you will see. Everybody on social media is always predicting. If the Nifty crosses this, it will go there. If the Nifty goes below this, it will fall here. The index will gain so much, etc. Those things keep going on, but that is rubbish. Those are predictions because everybody wants to hear predictions. They're actually worse than, let's say, things like palmistry or astronomy, which also try to predict. At least there is some method. Over here, there is only madness. So forget the prediction part of it. That is the main idea behind the random walk hypothesis. You simply cannot predict what the market will do. But as I said, over a 3-year period, not much of a problem there. you will get your very good returns. So that's the random walk hypothesis. The efficient market hypothesis is a complicated one. This is the one that is mocked most in the books you will read, whether they are fundamental books or technical books. The first thing they will do is to mock the efficient market hypothesis. And the reason for this is because it doesn't really work. It does work, but it doesn't work in the way people think it would. So the efficient market hypothesis is basically saying that prices are efficient. And what does efficient mean? It means that everything is all. One second, I'll have to just let the dog out of the room. Excuse me for a second. There we are. Yeah, so the efficient market hypothesis is saying the market prices reflect all possible information. You do not have any advantage at all in any way by knowing something or doing something because it's all factored into the price. Now, if that were the case, a lot of things wouldn't work. Value investing would not work because if there is, you might have heard the term value investing. It's basically just saying that if a stock is cheaper than what it should be, you buy it and it'll eventually pay off. This is a good method, it works. There's something called momentum investing. That won't work. That means if you chase stocks which are going up or build a portfolio of such stocks, that portfolio goes up and it works pretty well when the markets are strong. This also wouldn't work, but it does work. So the markets are not efficient, but they are at least partly efficient. Many of the things that happen are because of efficiency. One of the things the efficient markets would tell you is that you cannot beat the index. And this turns out to be true because if you look at studies, there is a specific one called SPIVA, which is done by Standard & Poor's. It shows that 95% of the mutual funds over a 3-4 year period underperform an index. So beating the index is extremely difficult. Now, this is actually turns out to be true because that's what the efficient market theory or hypothesis also tells, that you cannot beat the index. So simply because the index represents the market, so every stock and what it is doing. So the question now is, what do we do about this? So fine, we have the efficient market hypothesis. The efficient market hypothesis gives you one extremely important statement, and that is that not beating the index part is very difficult. So what is the next best thing you can do? It is simply that you invest in the index. So if it's so difficult to beat, let me just have the index. I mean, what's wrong with that? We are not saying it's impossible to beat the index, mind you. You may be able to beat the index. Value investors have consistently, or many of them, have beaten the index consistently. I know a few who have generally done better than the index. I also know a lot more who haven't. But you do get people who manage to beat index consistently. You could be one of them. But if you have a lot of time, if you're really good at it, you might be able to do it. And maybe you're just lucky also. But by and large, very, very difficult to beat the index. So the answer to that and the solution of the efficient market hypothesis itself is you buy index ETFs or index funds. Index ETFs are preferred. Now, let me explain these two things, because if you're wondering what is an index ETF and index fund, it's simply a fund, like a mutual fund, which replicates the index. It'll have the same stocks as in the index in the fund in the same proportion as the index does. The advantage of such a fund is that the stocks don't have to be adjusted every day, because since they're in the same proportion as the index, they'll remain in that same proportion. You would only need to adjust it if you had got them in your own proportion and not the one in the index. You work out the maths, you'll see it's quite easy actually, why it is so. Whereas an index ETF, the difference is that it's actually traded in the market and it's even lower cost than an index fund typically. So that actually gives you the benefit that in a mutual fund, you have to pay 2-3% at least. You don't have to do that with an index fund. And so you're already getting 2-3% higher returns. Plus, you have the advantage that you'll most likely beat the other mutual funds, which are standing alone by themselves. So this is one simple solution. This is the main thing. I've bypassed all the very good methods that you have in the market for making money, and almost told you they don't work. But it is not true that they don't work. There are chances over there, but it's not very easy. So if you are really good at it and you can work on it, then fine. But you don't know if you are very good until you have tried it for 5 to 10 years. So in the very beginning, I would say keep a keep most of your savings in an index ETF, and part of it you can experiment with your own investment strategies or mutual fund if you like the mutual fund very much for some reason. But remember, you straight away got a 2-3% loss. And when you're talking about the SENSEX with say a 1% or 1.5% yield, would have been double over 30 years. You think about losing 2% to a mutual fund every year, how much difference it will make to your potential savings 30 years from now, quite a bit. So the simple thing is just put some money into there are quite a few nifty ETFs right now. So that is a good thing. There were not so many earlier. There will hopefully be even a chance for you to start investing in ETFs that things like Vanguard in the US. So then you even have a diversified portfolio in the sense you've got US stocks, Indian stocks, emerging market stocks. So you get some really solid index funds into your portfolio. And that is, by the way, the secret of the professors I was telling you about. They buy these Vanguard emerging market portfolios and US stock portfolios, mainly the US stock funds. So so this is a simple thing you can do. And if you think you can beat the market, everybody thinks they can beat the market. That is why 95% you get those 95% to lose. Otherwise, they wouldn't be there at all. So it's not easy beating the market. We're not saying don't get discouraged. By all means, do the research. But the whole research business is an industry in itself, which is not really necessarily the best for investors. But it is an industry. It provides you employment. It gives you great jobs. You can become a legend if your fund does very well. So there are a lot of products involved with the market, which from a career point of view, you should definitely learn all the theories. And even from an investing point of view, if you like picking stocks, there are many things you can learn and do them pretty well. You might like trading because trading is also kind of fun. I mean, you might you get hunches because if you're watching the market, you see the stock is very likely to go up. Now, you don't want to trade every day, but if you're absolutely certain that, look, this stock, I'm willing to take a bet here that this is going to give me great returns next few months. So there you have a chance for trade. You can buy that stock or you buy an option. Many ways you can do this. So there are a lot of potential things you can do. Because on the one hand, I can say that ETFs are great and you can get fantastic returns, and this fits in all very well with theory, etc. But on the other hand, it's also very discouraging to tell people that, hey, nothing else works. So, but I'm not trying to do that. I'm just saying that there are a lot of other things you can do, and you can do them well. Two ways, one for yourself and one for the company you work for, or the research outfit you're with. Or you could be writing simply newsletters, you could be advising people. Because the point is that most people are not going to invest in ETFs. So a lot of people still want advice on what they want to buy. ETFs are not so appealing. They seem very dull and not everybody's cup of tea. They would rather not get their 2-3% extra returns for the sake of a little more excitement from the markets. So that in a nutshell is the aspect I was talking about. But let me talk about now the other part of it. We talked about efficient market hypothesis. Why the efficient market hypothesis basically says you can't beat the index, so have an index fund. That was the message there. But on the other hand, I've also mentioned in passing that some things do consistently beat the market. What are these things? I already mentioned two of them, value investing and momentum investing. There are times they don't do well, but for most times, these are investment strategies that do quite well. And if you are building your own portfolio from these, you might just build and to beat the index. Remember, you also got that 2-3% advantage, because if you're buying the stocks yourself and not going through a mutual fund, you got that 2-3% advantage right away over a mutual fund. Also, for your own portfolio, you're not really buying the kind of bulk purchasing a mutual fund has to do. It's not easy for a mutual fund to buy stocks and not disturb the price. So you will be able to do that yourself. So you'll have some efficiency on your side if you're building your own portfolios. So so you should learn these methods. There are chances that at some points of time you might do better than the index. So having a mix of the two is not a bad idea if you're an active sort of market investor, which a lot of people like to be. So what sort of, apart from these two, are there other methods apart from the two I mentioned, which is value and momentum investing? There are a lot of methods which are not talked about very much. There is, for example, something called PEAD, which is post-earnings announcement drift. I took this as a specific example. You'll find a list of these kind of strategies which work quite often. This was again a study done by universities. As I said, they are an excellent source. This is very strange, and this goes really against the efficient market hypothesis. A company announces its results. Now everybody, not just the efficient market theory, says, okay, it's too late. I should have guessed this result earlier and bought the stock. These earnings are great, but now it won't go up because it had already gone up until the earnings. How much more can it go? Now that is what PAG tells you, that people are slow to react to earnings news. In fact, this earnings comes out, but the stock takes a little while to start moving up quite often. Maybe there are some, you can give stories. You don't know whether these stories are true or false, but media will give you a lot of these stories. They'll say everybody knew this was going to happen, so they're all sold their stock. But that is all wrong. The surprising thing is you can actually lazily analyze the results of a company and say, okay, this is good, and buy the stock, and you will probably do very well to beat the market with that strategy. This is what this feed strategy is. I picked this one as an example. There are many others you can think about. You can find about, I should say. So these are all strategies which should not work in a purely efficient market, but they do work, which shows the markets are not fully efficient. But it is also does other things which show you that it is efficient enough to beat all the mutual funds. So you have to take the efficient market hypothesis as it is. It is a useful framework by which you can think about markets. It's not going to tell you perfectly that this is discounted or not. And most of these inefficiencies come in because obviously with computers and all running the markets, why should these inefficiencies exist? The answer is people. There is just a tendency, for example, in momentum investing, that a lot of traders and investors will buy stocks which are going up. So momentum investing works. Value investing is the opposite. There is a tendency for people not to buy stocks when they're falling. So you have a really good stock, but it's falling. So people say, oh, there must be something wrong with it. That's why it's falling. So let's not buy it. So earnings are great. It's screaming a buy from the value angle. It's also quite when you buy it and it keeps falling after you buy it, not very satisfied. So this is the Warren Buffett kind of method, which is buy stocks when they are really cheap, when markets have crashed. When people do not really want to buy, that's where you find value. So all these methods are there. You can find even things like Google Trends will tell you a lot about the stock market. If you look at the interest, Google Trends is basically just Google telling you how many people are searching for a particular term. So if you do a Google Trend search on Infosys and TCS and so on, and any companies of interest to you, and you find that some stock has started to show a lot more searches than it used to in the past, it's telling you something, that there is interest coming out from somewhere. Often it can be contrarian. They search for a term and they're worried. So when you have big crashes like 2008 and before 2020, you'll find a huge spike in the Google Trends term searches for SENSEX. So it might be better from that point of view to tell you when the market is about to bottom out, rather than to tell you that there is interest in a stock. But if the company is not that well known and there is a lot of searching, it could be indicative. But this is again, there are no fixed methodology here, but you can get information from unusual sources. This was really the point I was making. So in the context of everything I've said so far, after mentioning ETFs, what I'm really saying is that ETFs is a simple way of index ETFs, not any ETF. Index ETFs, market index ETFs, not specific ones. If you're buying a IT ETF or a auto ETF, you're only capturing part of the market. That's not efficient market hypothesis kind of investing. For that, you need an index fund which has got all kinds of stocks in it. It doesn't matter if auto looks good or that looks bad right now. You just buy an index fund. You don't know what will go up next. That's because of your random walk hypothesis. So these two hypotheses tell you that just go ahead and buy an index fund. What goes up will take your earnings up. I mean, your portfolio up anyway. So why are you worried? But though this is a sure shot way of ensuring that you've got a great savings, it doesn't mean that you can't do better. Difficult, but you can do it. Doing it means learning what are the methods that work. It's not so difficult to learn what works, and then stick to them. And then see, first of all, if it's working. And do it in conjunction with your ETF. And evaluate yourself. You can know how you're doing. It's much simpler than it seems. But you have the simple ETF method. Okay, lastly, I will mention one last thing, which is bubbles. Bubbles happen in the market. This doesn't really fit in into the context of everything I've said so far. So it's a slightly standalone subject. Bubbles are a time when people go crazy. We saw one in 2008. I think many of you may not have seen the 2008 bubble, but you do see bubbles happening all the time. In the crypto market, there was bubbles happen quite often, where there is a lot of madness, TV advertisements, social media, Google searches. You find that there's a huge amount of interest and all kinds of crazy predictions. So bubble is possibly a time you might want to lighten up on your portfolio, but do it only if you're convinced, if there is really a good reason, not just people saying it's a bubble, but when you really see madness around you. So I just mentioned bubble because it's a term you'll come across very often. And then becomes the question of how you deal with it. Right, so this is it. This is what I was mentioning. I'll just sum up in one sentence everything that we've said so far. From your point of view as a person, you certainly want to invest your savings in the market. Simplest, fail-safe way of doing it is a monthly investment in SIP, if you want to call it that way. I'm not calling it an SIP because SIPs are very specific schemes being offered by companies. So that might cause confusion. So I will just say that you just invest a little bit of your money every month into yourself. Do it yourself. Don't leave it to a third party. I mean, you could leave automatic instructions with your bank account and your. That is okay. That is the same as doing it yourself. But if you every time you go through a third party, you are paying costs, and those costs cost you in the long run. So simple thing is just invest in ETFs. You'll have great savings in a few years' time. Second aspect is that the only thing we can do? Answer is no. There are many ways you can try and beat the market. You might even succeed as an individual investor. And value investing, momentum investing, PAD, like that, there are many methods. So those are worth learning and doing. Trading is exciting, but don't leave your job for it. Don't go overboard on it. You'll be constantly told that this method is great and it works, etc. But anybody who's telling you that is for trading usually wouldn't be trading if he was really wouldn't be selling such a product if he was or selling his advice. He's obviously making money from the advice he's selling, not from the method itself. If I had a method on trading which was doing extremely well, I would be a little reluctant to sell it because once the method starts being used a lot, it will stop working. So if such a method exists at all in theory, and the computers haven't found that itself is unlikely. So this is it. And now, any questions? I'm ready to answer.
Sir, I have quite a few questions in the chat, so I would take some of them with you.
Sure.
So first one is Neil is asking you, I've been trading and I feel if someone learns technical analysis, then the chances of earning through trading increases a bit.
See, technical analysis, what is technical analysis? We're looking at price-based information, and you're either looking at a chart and some patterns, or you're going to use some indicators and which give you a buy or sell signal. These have not really been proven academically to give consistent returns. There are one or two things which have generally outperformed other methods, like a 2 moving average crossover has got reasonably good results. It might even be able to beat, well, I wouldn't say always beat the index, but come close to index kind of returns at times. So technical analysis is, I would say it's a useful tool for trading setups, and you should do it yourself really, not rely on somebody else's advice. If you are following somebody else's advice, it should be advice based on a method you understand what he's doing. It shouldn't be fully subjective. You ask him, okay, I don't have the time to do this analysis, but you are doing your analysis in a method I like. So, but you are doing all the computations for me and just alerting me when this happens and giving me a little commentary. Fine, that is okay. But if there is somebody who says, hey, I use these magical methods and it works very well, I would not trust such a situation.
So how do you see the market in coming years? Or let's say
it's random. So I mean, I can't give you this answer without contradicting myself, because I was saying that share prices are unpredictable in the future. But let's look at what is happening now. It's not difficult to describe where the market is right now. So what you really end up doing is looking at what the market is doing right now, and then assuming it will continue to do so later. So let's make that assumption, right? So this is true as long as the market behaves the way it is doing right now. This is not a prediction. It is just saying a description of the market. So we had the market had fallen quite a bit. And there was a good reason for the market to fall, which is it went up in the first place because of the US government let loose a lot of policies by which liquidity or money came flooding into the markets. Right from, if you look at the US money supply chart, look at the M3 on a website called tradingeconomics.com. It's very informative. Because if you look at the M3 money supply chart in the US, you'll find that exactly at the market bottom, this money supply chart, which anyway keeps going up at a certain pace. From that March thing, it started going up vertically. And whenever you release money into the economy, what does release money mean? You either give money to the you lower interest rates so people can borrow, so that the rich guys will do because the poor guys are not given money. So the you have, for example, when Microsoft bought out LinkedIn, Microsoft had enough cash reserves to buy LinkedIn by itself, but by themselves. But they took the loan because it was practically 0%. So that's when you're giving money at 0%, 1%, that's a gift to the people with who don't need the money. So I mean, this is very slightly socialistic here, but that is how the system works. So you got to follow the money flow. So what we had here was slightly different. The money was given to the people who didn't have it. But it has still the same effect because when people who don't have the money get the money, they will not send it to the Cayman Islands, but they will spend it. But if they spend the money, it's ultimately profits which go, up right up to the companies that own it, and then there are more investments. It does trigger the economy, and the surplus money ultimately comes into the market. So whenever anything is done by any government to increase money with the people or with large companies, the market always goes up. This is almost a certainty. So we had this rally from 2020 based on this. And what happened a few months ago was they said, okay, we've given enough money, which really meant that we don't have any more money to give. So we are going to start tightening up. And from then on, the market started falling. I personally thought it would fall quite a lot. It's fallen, about 10, 15% or so. A lot of stocks have fallen a lot. But in the since the Ukraine war began, the markets have turned bullish again. I don't think it's really a coincidence because the minute there is bad news, the government does things to again increase the money supply or to go hold back on their plans to tighten up things. So I think this is happening. Nobody said anything, but the Fed did increase interest rates by 0.25%. They have not raised rates for ages. But it was expected the Fed would also say that we're going to raise it 6 times this year or 5 times a year, 10 times a year, and something like that. Rate increase is not going to stop. That statement did not come. So, I mean, he made gentle sounds. These gentle sounds make a big difference to the market. So it means basically that right now, again, liquidity is not going to dry up too quickly. This seems to be the message. This is all speculation. We don't really know what's on the minds of the powers that be. The US drives the entire global markets, including us. Also keep that in mind. The entire, if you look at the markets, people keep looking for local reasons, but it's really you start off by looking at what is happening in Asian markets. Pretty much the same thing before we open. It's pretty much the same that happens here. Afternoon, you look at what's happening to the European markets. That's pretty much what happens to us here in the afternoon. So it's like a 24-hour cycle. We are just part of it. So the US, though they have not said it, if the Ukraine war is slowing them down or people are expecting it slowing down, maybe that's the reason for the boost. But somebody's talked about technical analysis. A lot of charts look like they're bottoming out. A lot of stocks have bottomed out. So this looks like the beginning of another run-up. I mean, which shouldn't be happening, but it is happening. You can't deny it. So that's the outlook for the market. How far it goes, I mean, who can say? Could be it goes on like this for a month or two, and then again starts looking bearish. Maybe we are just going to go through a cycle where every 4 months, 5 months, it starts looking like a new bull market or a new bear market. Or if the thing continues like this, maybe we get another year out of the market like this, maybe even new highs. But it cannot sustain because you can't keep feeding money into the system or keep it loose for very long. So I would say that there is short to medium term, it doesn't look too bad. But I think if the Ukraine war stops, look out because then it might start falling again.
Uh, okay, wonderful. The next question comes from Sudhin sir. He wants to know how to identify if a bottom is in place and what are the signs of a top being made.
Okay, this is a lovely thing to know if one can do it, but it shouldn't be part of your strategy because it can, for every one bottom you correctly identify, you will identify 5 false bottoms, or you will identify 5 false tops, and then that causes you to get out of your portfolio too soon. So, but let me talk about the signs. One is bottoms probably are a little easier because there is panic. I mean, you can notice panic very easily. If you just look at the newspaper headlines, March 2020, you will see what is going on. The newspaper headlines switch from the usual politics. They start switching instead to how much wealth is being lost every day, and how people are suffering, how stocks are getting worse. COVID is terrible because the whole thing was due to COVID. So everything turns pessimistic. Your friends and relatives, they all start selling their stocks, which they hadn't sold all this time. So when you find that sort of panic, you yourself start dreading. I think one best way to identify bottom is look at yourself. I mean, how do you feel about the markets? It feels like a horrible time to get in. Yeah, then it's probably the bottom. So, I mean, if it goes totally against your senses, everything looks terrible, gloomy, that it should crash, then you just fight that feeling yourself and put some money in the market. That's a bottom time.
Okay.
As far as tops are concerned, much more difficult. But when you have a bubble like 2008, when everybody is just raving about how the future is unlimited, bright, there'll never be bear markets, that's a bubble. But those are rare. They don't happen very often.
So some of the books, couple of books that you would recommend people to learn, to read?
Well, I've actually put up a list of books on my website. There's a whole list, a lot of them. So I would just suggest, just go there. It's trendwatchindia.com. And there's a huge number of list of books to read there. So I wouldn't really single out a single book as such, because there are good books on all subjects. I would recommend some YouTube lectures though. If you want to learn about valuations, nobody to beat Professor Damodaran of Stern University. He's called in global circles. He's called the father of father of valuation. So he even does Indian stocks from time to time. He did Zomato and Paytm, and you can find that in his blogs. So he's excellent to learn valuations. Professor Schiller, he runs some courses. He got the Nobel Prize a few years back. He has a lot of material. Yale University on YouTube. All those classes are free. So those are two very great resources to look for. Taleb you'll find quite a lot, but his statements are quite complex and very offbeat. So they're not always very easy to understand where they're going. But these two professors are phenomenal. You can learn a lot on the internet with these two.
Sir, Sudhin is again asking you from you, what would you do if a blue chip isn't performing for years? For now, for example, ITC.
I knew it was coming. Well, ITC has been quite strong. It's been a bit of a momentum stock in the last 2-3 months. But about ITC, you've got to remember one thing. Their main business is still the cigarette business. The terminal value of a cigarette business is zero. Because, there's a lot of health awareness. Fewer people smoke now than they used to in the past. So while they've been trying all kinds of things, the main nature of the company is very different. So I'm not, they are very profitable, etc. But, where is the growth going to come from? If the company has to grow, they have to sell more cigarettes. That's their main product. So I would right now, ITC looks quite good. So if you were looking to buy something for 2-3 months, which is, I don't think ITC is bad, but whether it's really a stock that you want to own for the long term, whether it's, I'm not sure.
Sir, what about the liquidity risks in ETFs? Is it overplayed?
That's a good question, because there is a parallel question somebody had asked: what happens if everybody bought ETFs and nothing else? What happens to the other stocks? The answer to that is generally that won't happen, because if everybody bought ETFs, there'll be enough people attracted to other stocks because they're missing out or they're undervalued. So I think this is where the one good thing about the human population is people don't think alike, not just in politics, but in all aspects. If there are a lot of people going for ETF, you'll not find all people going for ETF at all. immediately there'll be a rush of people going for stocks which are not in ETFs. So ETFs, nothing has happened so far. It's not, if there is, I mean, we had a lot of sell-offs. We had that COVID sell-off. All these ETFs survived very nicely through the process. So I don't see why ETFs would be any greater risk than a mutual fund or anything else. There's nothing especially different about an ETF than any other kind of fund.
So especially pertaining to intraday trading, sir, the question is how to determine entry and exit points.
Well, a simple way is breakouts. This works quite nicely, especially when the moves within the day are, when the market is making pretty good moves during the day. I mean, let's say if the Nifty is moving, say, a couple of 100 points during the day, this method will be quite good. First of all, you find a stock which has got momentum. What does that mean? That it's got good gains over the or losses, because you might also want to go short. Over the last 1 week, 1 month, you find the stock has generally been in a decline or generally going up. So in this process, what is happening is, what you're betting on is that you're capturing part of this move it's been making and expecting that it will continue making during the day. So what you need to do is to get a stock which is inside a small range. Small range, I mean like 1% or 1.5%, something really small. Not because that predicts a great move once it breaks out from that range, but because you get a very close stop loss. The other side of the range is your stop loss. So you get yourself a good trade set up, and then you place an order that if it goes above or below a certain level, you'll get a breakout. This also I've described on my site as an intraday breaking out method. So you can see the exact details there. But the overall thing is breakout from a narrow range in a momentum stock.
Perfect. So that was extremely amazing and a great learning to all of us hearing you today, sir.